Hey, welcome back to video 3 in our Become the Banker series. I'm Barry Page. Let's get started. You may now have your policy approved and in force. If not, you still have a little time to decide exactly how you'll utilize your policy. You've structured and funded your policy the way you determined and contracted with the carrier. The question you may have now is exactly how do I use this for banking? So in this video, I'm going to discuss exactly how you can use your contract, your life insurance policy, the banking function for privatized banking, infinite banking, for just about anything really you want. I'm going to talk about a few ways that you can do that as Nelson Nash describes in the book, Becoming Your Own Banker. This is how infinite banking, IBC, really happened. There is no magic. You stop being a slave to the lender and you become the banker. Just remember, banking is a process and you're in control. So your behavior will determine the outcome. All right, so here's the core idea, how it actually works. Once you've capitalized your policy, rule number 2, don't be afraid to capitalize. Your available cash flow, your cash value will grow. So at that time, you can generally borrow up to 80, 90, maybe even 95% of the cash surrender value. This is all going to be determined by how you paid premiums. Once your policy is capitalized, it's started to increase in cash value. You can borrow against the cash value for anything on your terms. This means cars, real estate, business investments, any major expense you can finance through your policy. Even education. Maybe you want to fund your children's college, or maybe you have some weddings to pay for. The insurance company lends you money from their capital pool, and the loan is collateralized by your death benefit. There are no credit checks, no pesky questions, and no lengthy application. There's no taxes, no interest, no fees or deductions. Whatever you determine to borrow, that's the amount you will receive. The money can be transferred electronically to your checking account, or a check can be mailed to you, and you'll have the available cash within 3 to 7 days typically. Here's the best part. While you're using the money, while you have an outstanding loan, your policy continues to grow uninterrupted, even though you have an outstanding loan. Some carriers may ding your dividend a small bit, but those carriers also usually pay the highest dividends. So it's all relative. It's the difference between fixed and variable rates. Here's how it actually works. Let me walk you through the exact process. Step 1, you decide what you want to finance. Step 2, you call or email your agent and let them know how much you want to borrow. This is only the first time, so you learn the process and to encourage you to set up a repayment schedule. But nowadays, you can pretty much do these loans within 30 days on your own from your cell phone. Step 3, the company sends you the money. It's important to set up a repayment schedule from the beginning. However, if you miss payments or you can't make a payment, that's fine. You just want to be an honest banker. They're not going to ding your credit. There are no late fees. You can repay the loan on your schedule. You may skip an entire year. You may skip a month. You may double up, triple up on payments when you get a bonus. You can set up a repayment schedule via bank draft. So if you're paying monthly already, it's pretty easy. Every time you repay the loan, it goes to principal. This will reduce the interest that will be due on the policy anniversary. You repay interest once a year. That money goes to the insurance company coffers. As a policy owner, you participate in the surplus via dividends paid by the company. Principal repayments can be made on your terms. That money goes back into your policy and is reflected in the cash values. All the while, your policy continues to grow guaranteed. This means the cash values and the death benefit increase. Your policy continues to compound uninterrupted by your outstanding loan. Let's look at some real world examples. These are ways that my clients have used their policies in their everyday lives and in business. So paying for major purchases is probably the most popular method. Things happen, life happens. You may have an air conditioner that goes out. You may have a small emergency room visit. Who knows? It could be a storm came and you need a roof on your house real quick, as I personally have experienced. So this is how most people get started with banking. Instead of using a credit card or borrowing money through a lending financial institution, you can simply borrow against your policy. My clients borrow from their cash value and repay the loans just like they would a traditional lender. The difference is you can remain in control of this banking function. So you set the terms. And over time, cost and lost opportunity cost will be recovered. And possibly you've used the money for other things. Buying new or used cars. The kids always grow up and want cars. You probably have purchased many cars over your lifetime or will. So in the book, Becoming Your Own Banker, Nelson Nash makes the example of purchasing cars over a 40-year time period and the 5 ways that you can do that. He's merely comparing the different ways that you could pay for an automobile. Nothing more, nothing less. And he's trying to make comparable payments, repayments to each. There are a number of ways to access the cash values available in a policy. You can surrender, you can take loans or distributions. In the beginning, depending on how you fund your system, the IBC method may be a little slower to catch steam. But over time, the more you utilize your system, the stronger it becomes, the more the engineering, the actuarial design proves profitable, surpluses are paid, dividends accumulate, and your policy grows more rapidly. So why not finance your vehicles through your own privatized banking system and recover money that you would normally transfer away to the lending institution? Another example may be a real estate down payment or a cash purchase or an investment property. If it's the home you'll live in, you may need the earnest money deposit or a 20% down payment to avoid paying PMI, primary mortgage insurance cost. This may provide that. If it's an investment property, you can actually increase your profits just by banking at home. Maybe you want to start a business, or maybe you're trying to scale your current business. Think of IBC as a line of credit that you can access at any time for any reason without any more bank qualifying, without paperwork or hassle. There are many examples of people using their life insurance over history. People like Walt Disney, Ray Kroc, J.C. Penney, using their policies to create their empires. You just have to think about it. Paying for education or funding college, or even family events, vacations, or weddings. Recently, I had a client who purchased a home for his daughter while she was attending law school. Over this time, he repaid the loan and now owns the property outright. They can rent the home, the policy's still in force. Meanwhile, it continued to grow even with an outstanding loan. He paid the loan back, and now everything is whole again. The key is really thinking like a banker. Once you change that mindset, it's really infinite. You're no longer spending interest with someone else's bank. You are the banker. You're paying back interest into a system that you participate in, and your principal goes directly to your privatized system that you own and control. A few quick rules just so you create a sustainable system for you and your family. Repay loans. As soon as you decide to take a loan, you should already be thinking about how you're going to repay the loan. You can repay on your schedule, but it's just a discipline thing, a good idea to set up a repayment schedule to hold yourself accountable. If you miss a payment, you're not going to get any hate mail or whatnot. Now, if you don't pay your interest once a year, they will send you a letter about that. You'll get a letter as soon as you take a loan, typically, or an email, just discussing what happened, showing the loan coming out and the interest that will be due on the policy anniversary. You can repay the loan on your schedule, not a bank amortization. However, you should repay the loans just like an honest banker, at least during your working years while you're receiving a paycheck. Think long term. This is not magic and it doesn't happen overnight. It's definitely not get rich quick. Although, if you think you can use this to fund opportunities where you can possibly make huge gains via the right investments at the right time. It's simply a tool that you can use over your lifetime to finance your major purchases and recover wealth transfers that you would normally pay to someone else, and then transfer the death benefit tax-free to your family and heirs. Your behavior in managing this process will determine the outcome. It's really hard to mess it up. You've reduced your risk from day one. Responsible cash flow management will yield positive results, and company surpluses will pay dividends. So there you have it, video 3 of 3. You now know how to get started, how to structure and fund your system, and how to use your policy for financing while you become the banker. If you want the full checklist I offer to my clients, the exact 3-step process for funding, the structure, and usage guide, just comment banker below and I'll send it to you. Make sure you're subscribed and hit the little bell so you're reminded when I have new videos. This is how you take back control of your money. The banks have had their turn, now it's yours. Thanks for watching, and I'll see you in the next video.